Hey everyone, welcome back. Happy Tuesday. Hope you're having an awesome day. I know I am. Karina and I just got back from a lovely walk and we are getting into this market. A relatively flat day today. I'm going to jump into the screen here. We're looking at IBKR, and it's a platform that I use because I'm Canadian. And because I'm Canadian, there's not a lot of choice out there. I get to use IBKR because one, I love it, and two, they have extremely low fees. So if you guys are interested in looking for a new platform, if you're Canadian or in any other country, I mean, IBKR is a great platform. I don't know why I'm looking at my name. Let's turn that off. Let's go to this. That's better. Okay, rundown here. Q's looking at NASDAQ or QQQ trading at 273, down 0.37%. We kind of had a bit of an up move this morning. If we look at the 1 minute chart, the daily candles are down here slightly. But if we look at the 15-minute candles, for what's happened today, we kind of opened a little bit strong, and then we've dropped down, and we've just been trading sideways for the last couple of hours, which is, pretty typical of these last couple of sessions, that we've had this kind of much of the movement of the day is happening relatively early, and then I'm seeing flat for the remainder of the day. And one of the things that I've been doing as of late on Monday, Wednesdays, and Fridays, I've actually been doing some zero DTE trades because of this action. So entering when there's high volatility at the start of a Monday, having the stock run up and then settle out and trade back relatively flat on the day if we're looking at positions, overall traveling kind of flat most of these days. Now here we've got from the open, obviously we opened here and now we're trading down. But if we look at from the previous close, we're barely down at all. So this is not a huge amount of movement on the week. So if we look back from obviously Monday start, we're just slightly downtrending right now, which is keeping with this trend. There is a ton of bearish sentiment out there in the market right now. And if we look back at kind of the bigger picture on these stocks, we'll see that we're hitting these levels that we saw back in June. And this is pretty interesting because there's actually, it's corresponding quite well with some of the other data that is showing us that we may be at a bottom and we may see a reversal, and we may see a move to the upside like this. When you're wondering what kind of data that I would look at for that, one of the things I shared with my patrons this morning was the CNN fear gauge. Let me just pull it up here. CNN. Now, I am not a huge fan of CNN in general, but I find this tool to be quite good. So I'm just going to pull this over so you guys can see this. So this is the pre-markets. I mean, this is what I look at it on a nightly basis before I go to bed. I'm always looking at these futures to kind of give myself an idea of what's going to happen in the morning. During the day, obviously, I'm not so concerned about it. But right up top here, we've got the Fearian Greed Index. And what this does is it shows, where the fear level is right now. And, Warren Buffett always has said for his lifetime, be greedy when others are fearful. And I think that this gauge kind of gives us a good indication of that. If we look at the timeline, we look back to when the fear was high here. We in June, we were kind of neutral, and then suddenly we had an extreme amount of fear, June 17th. And then if we look at what the stock market did at that time, we can see that corresponds with a move to the upside. That arrow doesn't look very good, does it? Let me try that again. We can see a move to the upside from that June, kind of last week of June, which we saw was a extreme fear situation. We're seeing those levels again. So this is lower valuation, lower momentum, and potential rebound here. So I'm looking at the market thinking that stock price index obviously indicating fear. We're seeing low valuations, and again seeing similar levels to when we saw at the end of June, kind of in this -5 range. And as the market rallied, the fear dissipated here on the stock price strength. Extreme fear, all of these are extreme fear. The other thing is a big one is this June 16th, you can see 110 was the put to call ratio, and we're getting very, very close to that, 1.08. as of today, put to call ratio. So there's a ton of people out there buying puts because they're worried that this market's just going to keep falling. And to me, when we see all of these corresponding actions happening at the same time, we see the VIX is spiking. We're seeing that repeating. And I'm not saying history is going to repeat itself. It's just that these are indicators that we may be in a situation where people start to buy up products. And we take it for what it is. We're always looking at different market data and seeing what we can see. Just make sure. Chris is saying he wants to look at XOP, which I think is a really good stock to look at. XOP obviously is the energy sector. If we jump over to Seeking Alpha, I'm just going to pull up XOP. It's the oil and gas exploration product. It's ETF. Quant ratings on this currently are a buy. This is an ETF, so it's a basket of stocks. The holdings in this, we can see here, Occidental Petroleum, some of these smaller stocks that you may want exposure to in your account. So when we look at this, just hit that button, ExxonMobil, 2%, basically weighting across a bunch of different oil and gas related companies, including some of the big ones like Exxon. Number of holdings, 64 different companies when we're looking at a company like this. Now, is there a dividend on this? There is a dividend yield of 2.5%. So in this case, when I'm trading positions like this, there is a benefit to holding stock. I don't necessarily have to hold stock, but if I am going to, at least while I'm holding stock in a longer duration, then I can collect this dividend yield. Now, if we look at the summary, let's look at the ratings. Actually, this is kind of a fun thing. We'll see it doesn't have the little chart here. But the quant rating has been a strong buy for a while and actually just got downgraded to just a buy in the last couple of days here. But overall, a buy. It's got dividends, which are very safe. There's obviously a bit of risk to the oil sector in general, and it's ranked kind of in the middle here. So I am not opposed to playing this at all. And how would we play this? So one of the things that I said was, buying stock can be a good position. Let's take a look at TradingView, actually see when the actual dividend is. So if we go to XOP, Bruce says, hello from Langley, BC. Well, hello, Bruce. Thanks for letting me know where you're hailing from. I always appreciate that. If you guys want to let me know where you're calling in from or watching from, that would be amazing. It's always fun to kind of chat with people from different parts of the world. So looking at XOP, the dividend was actually just paid September 19th. So, and these dividends aren't massive. It is only a 2% dividend. So there's not a massive effect, but it means in a shorter duration trade, then I am going to not worry so much about dividends because it's only quarterly anyway. So in the short term, if I was in a position for a month, I don't have to worry about a dividend payout in this time frame, and there's no benefit to me holding the stock. I just have to have some sort of assumption on it. Now, if looking at the Bollinger Bands, we can see that this top band is quite flat at the moment. So I would assume that this stock could rebound quite heavily, and we've had quite a significant drop over the last couple of days. Now, this is directly correlated to the price of oil. If we look at this CL, Crude Oil Futures, you'll see that crude is trading down at 79 bucks. Let me turn this off. So 78.97 right now, dropping these last couple of days from 83. Now I trade futures on CL. So what I did today after this second kind of small candle, I actually tightened up my position to correspond with these Bollinger Bands. So my patrons saw that. I adjusted my upper limit. I'm no longer worried about making money if the price of oil jumps back up, because my expectation is neutral at this point. There may be some recovery, but mostly neutral moving forward. So that is how I'm playing crude. And when you play futures, I typically just adjust. I play strangles on them. So it's a pretty simple adjustment. I just am bringing the call side down on that adjustment to lower this range. As the stock moves, then I take it off and I put on a new futures contract following month and just kind of rinse and repeat with that. It works pretty well. These crude futures work, they're extremely capital efficient. So they actually pay out pretty decently, and we can make money when the stock goes down, which is key. You know, that's everybody always wants to know, how do we make money if the stocks go down? Well, let's look at XOP and see if we can come up with a trade. So trading at 117. Now, depending on the size of your account, if you don't have a massive account, I would be concerned about trading this in a small account without being able to buy 100 shares, which is kind of my default for most trades. But some people don't have that kind of capital. So let's take a look at a trade for larger accounts, and then we'll look at a trade for smaller accounts. Now, I want to reduce my volatility risk. So by doing that, I definitely don't want to trade anything in the coming 3 days, or sorry, the coming 3 weeks. I want to trade always a little bit longer than that. Right now, I'm trading November 4th. The VIX right now is 33.7, which is extremely high. This is a high IV environment, which means I tighten up my duration just a little bit. And then I play by delta numbers. Now, when the market has been extremely volatile, so what I'm looking to do, there's a couple of ways that I can look at this. I can look at delta and look at this column first off and say, okay, where is my valuation? Typically, I wouldn't trade longer duration trades on anything higher than around a 24, 25. Unless I really wanted to buy the stock, then I would trade up to a 50. Closer I trade to at the money, the more extrinsic value. So there's benefits of trading these higher risk positions because I can make more money off of them. Just higher extrinsic value. That's therefore higher theta decay as well. So if we look at the theta, the 90 put generates $6 a day. The 115 put generates $11 a day. So substantially larger amount of theta trading the at the money options. But the risk is if the stock trades under 115, I would start to lose money if I was trading the 115 put. So I have to be comparative with these positions, and I have to mitigate my risk as much as possible. I think in this market, even with a sideways assumption, I think risk mitigation is key. So the second thing I look at is actual value that I'm getting. So on a $100 stock, if I was assigned this position, I'm looking at a $10,000 position. 100 shares times 100 shares. $100 per share times 100 shares would be $10,000 position. So if I was in the position where I wanted to buy that, I would just sell the put at 19 delta, collecting $2.80. Now this is high IV environment. This is a ridiculously large amount of money. The fact that I'm getting almost 3% return is crazy. So just imagine I did this every single month. This is every 38 days. So if I was filled at 290, let's just calculate off 290, and we did that math, and we did that divided by 35 days, it works out to $8.28 a day if I leave it to expiration. Now, if I times that by 365, it works out to 3,024%. So this is 3,024%. That's crazy. That's high. $3,024. So $3,024 on a $10,000 investment, which is a 30% return annualized. And that's only the put. This is if I sold the call as well. And if it was to do that repeatedly every year, if I could get a similar valuation for the call, I would be looking at a position where I could make 60% annualized, which is massive. I don't generally like to take all that much risk. So even though this is a 19 delta, there is plenty of value in these lower strikes and just gives ourselves a little bit more wiggle room. So playing the 95 still gives us a 2% return. It's only a 14 delta, which means that it's an 86% probability of profit. If we click on the profile button here, you'll see that it'll show probability of profit 89% on this. The break even's 93. So if we take a look at the chart on this particular one, this trade, just that short put, would make money as long as the stock stayed above 93. Makes some money, of course. It makes the maximum profit if it stays above 95. So we have to keep that in mind as well. There's a little bit of a buffer there, and that's based on the difference or the amount of credit collected. So there's those two lines: max profit line 95 and above, and then minimum profit line, or minimum profit 93. Anything under 93 is a loss. So the stock could drop substantially, and I could still make a 2% a month, which is pretty great to be able to make 2% return. when I started trading options, my goal was to make 1% a month off of trades like this. So the fact that I can make 2 in a high IV environment is extremely, extremely lucrative trading right now. So that is the one position that I would consider. And then on the flip side, I almost always like to sell calls against this. And look, this 2 standard deviation isn't even enough. Let's just go to tab view here for a second. So we're looking at November 4th. And we're going to scroll down and we're going to see, where could I get, basically it's $144. I want to be, around this 14 delta. This would put me in a delta neutral position. There's not a lot of volume on here. So that's one thing to watch for. What's the volume like here? I'm surprised the volume's so poor. Let's, I'm going to backtrack here for a second. I'm going to go to November and there's the 95.15 delta. November 18th, this is the monthly, obviously way more contracts, a little bit more time because 52 days, it's an extra 14 days or almost 2 weeks. So maybe what I would do, I still have to try it for this one, the 95, because now that the duration is so long, almost 2 months, I would want to hold, I want to make sure that I'm getting enough credit. So that would be the upside there. And then selling the corresponding 16 call on the other side. This results in a cash flow today of $445. So this is a very basic neutral strategy setup. And basically you can see the break-evens here at 90.66 and 149.34. Now this is 52 days out. So let's take a look at our cone here. 90.66 and 149.34. So 90.66 and 149.34. So I might look at this and decide if my assumption was bullish on XOP, if I thought that these stocks had been beaten up and that there was more upside, I may not want to do this trade. I might want to take some skew off of this. I may want to skew it a little bit more to this side. But I'm adding this additional risk. So this is where options become extremely flexible. But if I thought that this sell-off with the oil prices dropping was unwarranted and the oil was going to drop, was going to climb back up, I may want to take a little bit of a contrarian trade and have a little bit wider range on this over the next 2 months. So 2 months being November 18th. I mean, this is about where the line is. So this is the goalpost. And you can see the standard deviation curve that IBKR is showing is this blue line, and that is the expectation. So by moving this up, I could be taking additional risk. Didn't mean to do that. So what I could do is I can kind of align this right with where it might be. So 91.88, this should be pretty easy to get. Let's take a look. 95, there's not a huge amount of strikes in here. So one thing that I could do to change this is I could turn the bottom side into a ratio spread, and that can be lucrative as well. So what I can do is I can buy 105 put and then sell 2 of the 100 puts. And in that case, what it's going to do is give me that 91.19 break even, so slightly higher with a potential profit spike up if the stock market did go, or if the XOP did go down. These types of trades, as soon as I'm into a ratio spread, I have to consider that I'm going to be holding this a little bit longer. This dotted line is going to be great for half the life of the trade, and as we get closer and closer, it very much functions like a strangle. If I want to take advantage of this region in the end, I have to be prepared that I'm going to be holding this right close to expiration. But what it does is it gives me a break even of 148.81 on the top side. And I didn't quite like that. Looking at these other candles, 153 was kind of where I wanted to be. So what I would need to do is just move this out a little bit and move out to the 150, still collecting $1. This is extremely easy money because well, of course it could get tested, but when the VIX is so high, we're just seeing a massive amount of premium in here. So now the credit collected would be around 360, and The margin impact is $3,143. And the margin could expand on this, right? The margin could go up to $5,000 if you've got a 50% margin capital requirement in your account, which is pretty typical for most trades. So let's take a look at that and just see where our break even was. Our break even is 153.23 now. So there's a trade, that I would feel pretty good about putting on, and knowing that I would have to hold that closer to expiration. 91.77. Just let me pull that. So that's kind of that's like pretty much bang on. That's where the trading range is. And if it was coming down here, it would be coming up into this profit spike, because there's actually a large zone where I could make money if the stock was trading at expiration right down in this zone between 110 and 100. In that case, 105 to 95 would be the range. But that is kind of how I set those types of things up, and it's that's how easy it is. Yeah, this is years and years and years of experience of doing this kind of thing and looking at these and analyzing and using charts. Like, I'm just not completely just going straight up neutral. So if you guys are interested, I've got my Patreon right now. There's actually just a change to my Patreon, which is pretty awesome. The billing changed. So now when you sign up for Patreon, you don't have to do it on the first of the month to take advantage of the full first month. It actually bills on the day that you sign up, which is pretty awesome. So if you guys have been considering Patreon and you were leery or waiting to the end of the month, which has always been a bit of a problem for my Patreon in general, now you can just sign up and you get charged when you renew on whatever date that is that you sign up, which is pretty awesome. Boy, I'm fumbly bumbly today. And as always, you can head over to my website. You can look at my charts and all the spreadsheets and stuff that I offer to do the comparisons, because I run a ton of different comparison software, and I look at trades quite frequently when I'm looking at my risk profiles. It's hard in IBKR to compare the risk profiles from one trade to another. So I have a comparison calculator that I built. It's part of my rolling options record keeper, which is free for my patrons. So it's a pretty awesome deal to sign up for my Patreon. You get the rolling options record keeper. You get to see my trades. You get to be in the chat room for a month or longer. Hopefully, I've got patrons that have been around for quite a few years now, and we get to trade together, and it's pretty great. We were talking this morning about hedging on Canadian hedged ETFs and whether or not that was a good idea. I think it is a good idea. I tend to trade options on my long Qs positions or my long SPY positions. So I typically don't use Canadian hedged ETFs, but it is something that I think is valuable. And I think now is the time, with the American dollar being so high and relative to the Canadian dollar, I think it's probably important for us to be looking at the types of advantages we have when we have currency exchange and whether or not we can take advantage of it. So for Canadians, getting into a Canadian hedged version of a SPY ETF like VSP, which I can just show you, can be advantageous to us because it can counteract some of the movement that could occur. VSP can occur if the dollar comes back down, the American dollar comes back down, which I expect at some point it will. But right now it is pushing up quite heavily, and obviously the dollar being strong is causing the price of oil to come down. So it's all inverse. I would be slightly bullish on oil overall, and I am slightly bullish. So which of these oil companies, Theory's asking, which of these oil companies do you prefer, SU or ENB? I think both are valid. Let's look at, how do I want to look at this? So Enbridge, ENB is Enbridge, SU is Suncor. Both are good companies. These are always questions. It's like, I don't really trade like that. I typically would hold some of both. Enbridge is profitable. Obviously, it has a decent dividend. I'm sure the dividend is higher than Suncor's right now. The dividend yield right now is 7.8. Whoops. Right now, 7.18% dividend yield. It pays out annually $2.67, but its payout ratio is actually really, really high based on its earnings. So is there risk to the dividend? Yes, a little bit. That number must be wrong. This is, the dividend safety here is only a C. Usually the payout ratio is not above 100%, so I'd have to do a little bit more research on that. I don't have a position in Enbridge right now. And then Suncor obviously is another oil company. Dividend yield 5.36%. Payout ratio is much, much smaller. And see they have the dividend safety is C+. So both are good stocks. I mean, when you're picking with these, I think that the options are a little bit easier to trade on Suncor. So if I was trading this, if I was looking for new positions in oil directly, from an option standpoint, I think Suncor has a slight advantage, even with the slightly lower dividend. If we look at the charts, oops, wrong one. If we look at the charts, let's just see. They should be trading very, very close to one another on their Bollinger Bands. So we can see Suncor dipped outside of its Bollinger Band, has kind of, the band has come down and is now encompassed this trading range, trading just barely below it. And if we look at Enbridge, oops, I can't tape today. Enbridge, same sort of thing. I mean, these companies are very, very highly correlated. So either one is fine for me. I have had better experience with Suncor with selling covered calls, and it is a very low valued stock, which is nice. So 100 shares are only, $2,200. Is that what the current price is? Suncor is at $22 today. $27. So $2,700 for 100 shares. So a very, very low valuation right now relative, and obviously still uptrending over time. These companies do make quite a lot of money, even when the price of oil drops further down than it is. At $50 a barrel, they're still making money. So the highly profitable company. And I don't think either of these are bad investments when we're looking at the range that they're trading in, which we haven't been able to buy them at this price since January of this year. So the stocks are on sale. Kind of amazing, right? Now, if you guys have specific questions about specific strategies, this is the time to ask. So if you're like, I don't understand, like, can you explain a put ratio spread? Can you explain a strangle? I will break it down in as much detail as you want. Otherwise, I'm going to go through the questions. And 3 saying Montreal, which is awesome. We've got Varengue calling in from Punta del Este in Uruguay, which is great. Lubistrani. What about Zim? Let's talk about Zim. What is going on with it? It is getting hammered down. I recently picked up some stocks, and obviously at these levels, I'm considering even buying a little bit more. One of the things that we are starting to see is this compression in the Bollinger. So this is unlike those oil stocks, which had the Bollinger Bands actually kind of trading sideways here. There's been quite a collapse, and I've been watching these pretty heavily because they are good indicators of future range. So when we see a collapse like this, so we saw a collapse before, it eventually bottoms out. And if we were to compare that kind of historically, looking at what happens, the stock dropped and then it kind of fell down and then it started to trade sideways for a while. Well, we're seeing another version of that. We're seeing this, not drawing very well, but we're seeing this kind of compression of the Bollinger, and then expectation is flat. This upper portion, this upper band is collapsing, and my expectation would be flat. If this area was to repeat, and I'm not saying that things do, but if it was to, if we're watching this price action, my expectation from here would be slightly bullish, not massively bullish, slightly bullish. So on positions, this is when we're having an update. What I want to do is make sure that I'm selling a covered call against my long stocks, or I'm, selling a naked call against any short puts that I have. When this has moved up significantly. Not really a good time to sell calls when the stock is trading down here, especially when my current assumption is slightly bullish. I think this band that we're seeing right here is enough for me. And with the current market sentiment, if we do see a turn, I think we're going to see a pretty strong rally, or this will be a bear market rally. I'm not expecting Zim to trade way up this year. If it does anything, it's going to just trade along in a range here. Could go lower, could go higher, but it's not going to go crazy. My expectation would be somewhere in this line for the remainder of the year until the Fed starts changing its tune. I mean, these interest rates are a killer for the economy in general. So every time they raise the rates, this is going to push down the stock prices more and more and more. There's no free money right now. So when there's no free money, people don't have extra money to be buying into the stock market. Bruce is saying, what is your recommended option strategy for RSP or TFSA accounts? Now, of course, I have a disclaimer. I don't offer advice or recommendations. This is only my opinion, but I can tell you what I do in my account. There is one position that I absolutely love to do, and it is a covered call. In RSPs, in TFSAs, it's the only short option position that I can play. So what do I mean by short option? It means that I'm generating positive theta decay. Let's look at a position that I quite like, a little stock that I typically hold. And I think I may have gone over this just recently in another video, but Dropbox is very, very low price product, and it is extremely lucrative in the amount of money that can be made on a monthly basis. So let's just look at the coming October 21st, 24 days. Now, covered calls are a bit of a unique beast because there's no upside risk. If the stock goes up, it's a bullish position. So I'm making money on the stock going up. I just am capping my potential profit. Now, the typical way for people to trade covered calls is to sell like a 30 delta call and collect some credit for this. What this does is it actually gives you, let me just pull up some shares here so we can see what it looks like. So in this case, I would be buying 100 shares, or if I already owned them, this gives me the same sort of result from today's valuation. So buying 100 shares, or at a cost basis of $20.10. And by cost basis, I've talked about this before. Cost basis is irrelevant. I can only make decisions on what the price is today. So the price of my shares today, $20.11. That's it. If I sell the October 21st, 2150 call, I can collect 30 cents. Now, this doesn't sound like a huge amount, but on a 24-day cycle, this is $34 extra in my account. Now, there's a couple of different things I can do with that money. I can just keep it in cash, and I can do with it what I want. I can buy stocks, or I can wait and buy stocks at a lower valuation, or I can buy different stocks. I can even roll it back into the same stock. So to enter this trade, the net liquidation valuation of this trade today would be $1,977. Now, the maximum that I would be able to get out of this trade, if the stock was to go up above 2150, would be $2,150. So this results in a net profit of $175 on the trade. We can see that if we just scroll over here, you can see the 172 showing. So we've increased the probability of profit by 5% over just holding a stock by itself. Maybe what I'll do, I'll show you a comparison in my comparison calculator, because I think visually it makes a lot of sense when you look at them side by side. Just give me one moment here. I'll pull it up. Wasn't quite prepared for this, but I will. I think that in light of this current conversation, it makes a lot of sense to show you exactly what I'm thinking and show you visually how this works. So if I go over to the trade comparison tab. Okay, here we go. Here we've got it loaded up. So this is Asana, but we can do it on anything. So if we're looking at DBX, and the current date is whatever you want it to be. The share price right now is $20, and what did we say it was trading at? We're trading at, okay, 2012, and we're gonna get 35 cents for the 2150. So we're just gonna plug those in, and we'll look at the comparison. So 2012 is the current price. If I owned 100 shares, or if I was buying them today, at expiration October 21st, if I did nothing, if I just held the long shares, then it's going to it's going to look like this on the chart. It's going to be this blue line. Now, what I could do is I could sell this 21.50 call, and I would be able to collect 35 cents. So in this case, it gives me a very, very small advantage, and it's partially because I'm zoomed way in or way out here. But if we zoom in just a tiny bit more, we can see that the second column in this case, the covered call, has a slight advantage in that it is collecting $35. So if the stock price doesn't move, then the covered call position made more money. It had $35 or made $35 that is going to expire worthless because the stock didn't run up. If the stock runs up, it's still making money. It's still a bullish position. And I think visually this makes a lot of sense. When we look at this break even, suddenly you can say, wow, that is the key. Where does this line, what does the stock price have to be before I start losing money? Well, it moves it over. The stock can drop that 35 cents before I actually lose money on this trade. And we can do that even further. So let's run a different one. Let's run an in the money covered call and see what that might look like. So I'm going to run the same thing. I'm going to pull up a covered call here, and we're going to do the same expiration, October 21st. If I can type, October 21st, but at this time, we're going to sell it at the money. What this does is, let's do just slightly in the money. What that does is it gives me cash back today. I'm going to get cash of $98 for this and for selling the 20 calls. So I'm basically buying stocks for $20.13, and I'm agreeing to sell those shares for $20, which is 13 cents lower than the current valuation. But I get 99 bucks in cash. So let's look at what that looks like in the comparison calculator. So if I was to do that, sell the 20 call and put in the 99, did one contract. Well, this is now the yellow line. You can see how much less risk is in my account. If the stock doesn't move, I make 87 bucks in this case. I still have my shares, and I have to pay 12 bucks to get out of the position that I sold for $98. And I would be net profit of $87 if the stock didn't move, as opposed to long shares, which I would have made nothing. Now, if the stock ran up to say $21 a share, let's look at 21. Just go up here. So 21, the covered call that was out of the money has a slight advantage. I would have profited $125. Now the long shares would have, or the in the money calls would have only made $87. That's the max profit that it can make. And the long shares would have made about the same, about 87 bucks. So you can see there's a correspondence if it went to 21. So it really becomes about what am I looking for in the current environment. And in this market environment right now, I am looking for lower break evens. There is nothing worse than losing money in a bear market, and giving myself this lower break even has a massive advantage. This is why I developed this type of software, so that I can say, well, here is my position. So I can go a little bit further. I can even see the percentage return of what the expectation would be. This obviously would be slightly less money. It would be 2012 minus the 35, which would be 1977. And it would show me that this would be a 30% compounding annualized return if the stock was to expire, if the option was to expire out of the money. So if the stock would have to rally above 21.50 in order for this 30% return. And it's only calculating the return on the options contract. It's not calculating out the return of the stock valuation. The chart factors both. So there's a little bit of information that is different on this side than it is on the chart. So the chart shows combined shares and option. This percentage on this chart is just the option contract. So in this case, we would be 2012 minus the 99, which would be 1913. So, and this is why there's less risk. You can see that the most amount of money that I could lose, because it only cost me $1,913 to enter this trade, If the stock was to go to zero, I'm only out 19.13. Well, if the stock was going to go to zero and I had 100 shares, I've actually lost $2,012. So I've actually lost substantially more risk. And this particular type of strategy is my favorite for TFSAs and RSPs because I can micromanage these positions really well. The other thing I could do is I could actually use this credit to buy stock. And so let's run just one more comparison here because while we're in it, we might as well. You'll see the power of this particular spreadsheet and how I use it in my day-to-day life. So if I sold this in the money and instead of taking this $99, what if I used the $99 to buy some shares? So I purchase some stocks. Well, I can just buy, how many would I be able to get? It's $20. So I would be able to buy 4 shares. Let's call it 5 shares at 2012. And so that would be 5 times 2012, which would be 106. So then my debit here would be negative 0.106. Basically is how that would work instead. And I would have 1 contract of that, but I would have purchased 5 shares. And then my total cost basis on this would be 2012. Now I can compare that. So if I wanted to use that call money to pick up extra shares, I could do that. If the stock rallied and the shares were called away, I would only lose 100 of my shares and I would have unlimited profit potential on the 5 additional shares that I picked up today. So that's one way of doing it, entering this value into this chart and seeing how I could get free shares. Very, very limited risk. In fact, still less risk doing that than just owning these long stocks. You can see the long stocks, if the stock was to drop down to 18 bucks, is the worst performer of any of these situations. Because I'm hoping that the stock is going to go up here, which is relatively unlikely. Let's look at Dropbox's chart and see when the last time it traded at $24, just to put it in comparison and why I wouldn't want to have that risk on. Or why I wouldn't want to have that hope on. So $24, it actually has traded in the last year that high. It traded it back in August. So only a month ago it was up at these levels. But you can see it was very short-lived. So unless I'm swing trading this, it's unlikely that I'm going to be in and out of these stocks. For long-term holdings and from a boring perspective of boring trading, I want to have positions on that make me money consistently and that I'm not in and out of stocks constantly looking for trading these swings. I just want to get into a position and then make money off of it all the time. So hopefully that answers your question, Bruce. Theory, what are the options on VFV on the TSX? I don't even know. What is VFV? VFV. Vanguard Investments, Canada, S&P 500 Index. There's so many. So, okay. So this is, I'm guessing this is a Canadian hedged, just because it says Canada in there. VFV on the TSX. Oh. So let's take a look here. And are there options? Yeah, there are. No volume, but they're there. So there's not enough volume for them to be worthwhile. So in this case, I mean, you can't do anything crazy with it. But if I was thinking there was more downside risk and I did want to sell that strategy that we were just talking about, is there value in selling an in the money call? Potentially. Let's take a look at the November 52 days and then buying stock. Is there money in this? This combo can only be, yeah, that's fine. Okay, so in this case, I can make $189, and this is a debit today of around 85 bucks ish. It's hard. The spreads are so wide. The spreads are tight on the stock, but with the no volume, it really depends on what you're getting. So assuming I'm getting down at the 295, which is what this would be calculated at, making 189 in 52 days, 189 divided by 52, times 365. Annualized would be $1,326 divided by 88.90. I'm just trying to figure out if it's in the range. So selling that in the money call works out to around 14.9% annualized. So that's if it fills at this $2.95. If I could get a better fill, then it would be better. Yes, that would be the only type of option strategy that I would even consider on this type of thing, where I'm buying stock and selling an in-the-money call. And is there a dividend on VFV? Yeah, there's the dividend, September and June. So it's a quarterly dividend, and it pays out 31 cents and 28 cents, 24 cents. So the dividend's been increasing, but the yield won't be massive, and the expense ratio is probably pretty high. I doubt it's covered on Seeking Alpha. Seeking Alpha has tons of American stocks, but not a ton of Canadian ones. So it is showing it here. Dividends, payout, the yield is 1%, and the expense ratio, current have no expense. Yeah, so I'd have to look into that and what the expense ratio is. That's my only concern with these types of things, is when we're doing this, if I'm getting a good value, I want to make sure that I'm having a good value from the management expense ratio, because there's some stocks that are just extremely low. Like if we look at VU, the Vanguard S&P 500 ETF in American dollars, the expenses here are only 0.03%. Now, if we compare that to SPY, the SPY is actually 3 times higher, that expense ratio. Now, the expense ratio is still super small. You know, in $1 million account, we're talking about $900 as opposed to $300 for holding the VU. I personally would much rather hold SPY, because I don't care about this $900 expense annually if I can sell options against it. The options more than make up that $600 deficit on $1 million position. So when we're talking about expense ratios that are this small, it's pretty irrelevant. When the expense ratios are like 0.75, that's a different story. We don't want to get into positions where we're looking at stocks that are too high, and we just have to do a little bit more research. Jeff Ha, be careful with Zim. It's just following freight rates, which are in a free fall. Yes, absolutely true. If we look at Zim, though, the quant rating as a whole. The one thing about Zim is that it's a highly profitable company. So when we look at the financials of it, the revenues are super high right now, and their operating income is just massive. So they do have some interest expense, which will actually hurt them, but they also have some interest in investment income. So it's kind of an interesting thing that what's going on. Like, they had quite a lot of investment income or interest income. So if you dive into the numbers, I believe that Zim is actually in a very good financial situation because of its profitability. The problem is right now, obviously, that it's not going to grow all that much, and it's got poor momentum. So absolutely, we have to be careful. And these may be long-term holds, and that's kind of what I'm ramping up for. Like, I'm putting in my positions stocks in my portfolio where I expect to hold them for a long time. Zim also has a very decent covered call writing premium on it. So the fact that it's a $24 stock right now, I mean, when its valuation was much higher, I'm glad that I wasn't buying, obviously, even when it was at $45. But as this valuation has dropped, I feel more comfortable buying, with the assumption is that it will eventually return back to these $60 levels. If we look, going back into middle of 2020, let's look at it a little bit further back. Obviously, the stock has rallied quite nicely over the last couple of years because rates have increased. And I think that these costs are going on to consumers. Sure, if the freight rates are dropping, then their income is going to suffer, but it's suffering from a very high profitability region already. So that's what I'm looking at, is that current profitability is massive. Understanding the risks of growth and momentum both being down. Again, playing super small. I mean, this, everything right now is like I'm buying small pieces. It's almost comical. It's like when you're buying 2 shares, 4 shares of things. But in this type of market, that is the approach that I'm taking, getting very, very tiny positions and not putting on larger chunks that I would normally do in a bullish market. When is the best moment to adjust a strangle when the stock is going down? Well, what we don't want to do is get whipsawed. So there's no best moment, but when we look at a chart of any company, and I did a video on strangles to straddles that I think really shows kind of how the momentum swing goes. But I like to use the Bollinger Bands. So in this case, if I was holding, let me just turn myself off for a second. If we're looking at VFF, and it doesn't matter what stock I'm looking at, but say I had put on a strangle up here, and when the stock was trading right here, and my expectation was that it was going to trade sideways, and I used the Bollinger Bands and I placed a trade. Well, the likelihood is that at this time I would have had my expiration date would have been here, and my adjustment date, my 21-day adjustment date would have been here. So as the stock moved down, and in this case, it moved down quite sharply, then I would have adjusted this with the assumption that it would come back up to the moving average. So if all of a sudden the stock was testing, I was only a couple days in, and the stock was trading here at this level, I changed my color here. If the stock was trading down here, which it was, it wouldn't make a huge amount of sense for me to be holding this line, because the stock would have to go all the way back up here to test, and if it traded sideways, it's very, very close to my short put in this case. So, and at this point, the Bollinger is starting to break down. What I would want to do is adjust this upper limit. So if I'm looking at that upper limit here and saying, okay, well, now this is tested, let's bring this down. And sometimes I'll do this quite aggressively. I might scratch out, this upper call and collect a credit to move this down. Now, if I wanted to be super aggressive about it, then I would move it down into a straddle. I would move this call all the way down into a straddle. But the risk with that, obviously, is that the stock could rebound. So typically what I do is I look at where it was at my entry point, I'm looking at that moving average, and I bring this down to bring the delta value into a proper range. So if we're looking at these levels, when we entered the trade, the delta values of these would have been neutral. This would have been, this would have been a 16 delta. So this is 16 delta. And then this bottom one would have been around 16 delta. Let's just say that's the numbers. Well, as soon as the stock has moved from that entry point down, what happens is that the delta has increased. It is no longer 16. It is now 50 delta, because that is trading at the money. This short call has like no delta value. It's probably like 0.3 or 0.03 delta, and it's not where I want it to be. So by moving down to a lower delta, moving this call down, I can neutralize the overall position. I can't do much about this put. It's got a 50 delta right now, but this one I can, say I move this down to a 0.2. Now overall, one of these negative, one of them is positive. My overall delta on this position is now 0.3. And is it the puts or the calls? I can never remember which one has negative. If we look at the deltas, so out of the money puts have a negative delta, and the calls have positive delta. So let's go back to this. So out of the money puts, so this has this would have been a negative 16. Now it's a negative 50. This would have been a positive 16 delta, moving to a positive 03 delta, moving the call down to a positive 20 delta, gives us a net negative delta of 30. So is that making sense? Yeah, I feel like that is. So overall, we could do that. If I wanted to completely neutralize delta, I would bring it all the way down to a straddle. Is there a best time? I think that over trading is a little bit hard. What I like to do is I like to kind of space out my trades. For my patrons, they see that I make adjustments once kind of per week is a typical of all of my positions. So I am not daily adjusting my positions. What I'm doing is I'm neutralizing delta and moving my strikes closer to at the money if necessary on a schedule that's around somewhere between 5 and 9 days. And that's pretty typical for me. And I like to chase things. I have no problem with my short duration trades, chasing these stocks as they move around, keeping the delta neutrality and playing at the money. In fact, a lot of my unicorn setups are just that. I mean, they're basically, I'm selling at the money positions, and I just want to hold at the money all the time. So if the stock moves down, I trade at the money. If it moves back up, I trade at the money. And I am over time moving with the stock price, collecting aggressive theta decay all the time. But I trade those positions. Like unicorns have a limited loss on the strategy. On strangles, the biggest key is getting out early. So when we're looking at that position and saying, well, here was my expected range. This is my drop dead date. This is my adjustment date. This is when the trade gets closed. And on that date, the trade gets closed. And in this case, the stock would have, from this entry point, would have barely moved at all. With no adjustment, we would have been in a very, very fine position. This likely would have been a profitable trade with no adjustment. And then I can recalibrate, put on a brand new trade that has an expiration date at the next cycle. And then I trade that as it moves down. This one a little bit further, this would have been a lost trade overall. And then we trade the next trade out with another position further out with the expectation wherever it is, recalibrating each time. So adjustments happen, but I like to do them somewhere between 5 and 9 days. Wilson is asking, can you explain how to manage covers calls when selling it at the money or close to, and then the stocks run up like it did in August? Also, when is the best time to sell at the money call versus a 30 delta? Well, it depends on assumption. So obviously I'll answer the second part of the question. When is the best time to sell the at the money call versus the 30 delta? It typically when we are in a worrisome situation where we're looking at a position, and I think that, let's just go look at Dropbox again here. If I was worried about this going down, then selling the at the money call gives me the most protection, or selling in the money call gives me even more protection. So I can trade this a little bit, swing trade, even with a long stock covered call position. At the money gives the most extrinsic value. So if we look at DBX, just looking from a purely extrinsic value position on 24 days, the at the money call gives 80 cents. The out of the money call or 30 delta gives only 35 cents. So from an extrinsic value decay point of view, the closer to at the money, the better. Really, this depends on how sideways I think the stock is going to trade. If I think that the stock is going to trade for the next month sideways, I will just trade this at the money. If I think it's going to go down, I'll trade it in the money. Because trading an in the money covered call is the same as playing a short put. So I'm eliminating any risk that I have of the stock dropping from this level down, but I'm also capping my profits. I can't make any more money. It's effectively like selling the stock on this day. So you have to be a little bit worried about how much money we're making off of it, and is it worthwhile? In this case, like making 3%, selling it at the money, you're getting a 3% return if the stock doesn't move up, or if it even does move up, which is pretty awesome. So if it moves sideways, you make 3%. If it moves up 3%, you can always take the money and put it into something else that it's a low valuation at the end of the month if it does run up. I'm never worried about a stock running up against a covered call unless I have naked calls against it. Let's look at an actual position. Just give me one moment here. I'll pull this up. And because, again, I think that there is, I'll just show you one that I managed right through, and how well it can work. I mean, IWM, I've got this little one expiring, and this was like almost poorly managed. But I'll show you exactly what I did and what the chart looks like. So this was a trade June 22nd. Stock was trading at 168. We're looking at IWM. So back in June 22nd, this was right near the bottom. I talked about this at the top of this live stream, how the levels June 21st, June 22nd were there was lots of fear. People were buying puts. The market was just going to completely dissipate and everything was going to go down. On that date, I sold a June 24th, which is only 2 days away. I sold a 166 strike. So I agreed to sell my shares for $166, even though they were trading at 168.36. What this did was it gave me downside protection. I got cash. I basically was converting some of my valuation in the stock to cash, and I got $3.67. My absolute cap on that, you can look at the chart, is this little blue line right here. The most I can make now is 131 bucks if the stock goes stays above 166. And it did. 2 days later, when I made the adjustment, the stock had actually rallied $5. So this is a pretty strong move up. And what I did was I rolled out at that 166 and I collected another $1.60. When it had, even on a strong move in the high volatility, I can roll out in time and collect money. So I was able to roll that without getting my shares called away and collect another $1.60. The following week, July 7th, and so the time frame that I increased this from was from June 4th, from June 24th to July 8th. So I rolled out 2 weeks. Then on July 7th, the stock was trading even higher. So we saw this rally up to 175. So from 173 over the course of the next 2 weeks, it only went up $1 and a bit. And I was able to roll this out to the 167. The stock is substantially higher, so I rolled up to a higher strike. And again, this is done for a net credit. I collected another $55. Then I did it again, July 18th. When the stock really started to get up here high, and I was thinking, well, now it's going to start peaking, I wanted to collect even more credit. So I started selling a second covered call. So now I have 100 shares. I have 100 shares here. I have the 167, which is a covered call, and then the 186, because my assumption was at this point in time that we've been in this trade for a month. The stock has run up. It's going to start petering out and it's not going to continue much higher at all. Well, I was totally wrong. Here, the stock went up to 184 and was very, very close to my position here, which was going to expire August 5th. And it was moving up quite quickly. So what I did was I rolled out, and this time I paid a small debit, but I've collected a credit all the way. I got 360 bucks, 160, 55, 218. So now I'm just paying back some of this. Well, as I'm doing that, I'm increasing my covered call from 167 to 170. That means that I'm going to potentially make $300 more. Well, I'm only paying 134 bucks to potentially make $300 more. And I moved my upper break even as well. So I moved that up to 188. And look, the stock continued to rally. It just keeps going. August 11th, now we're at 197. Well, I did the same thing. I went from the 175 from the 170 to the 175. From the 188, I just stayed static, even though they were both in the money at this point, and I paid a small debit to do this. But this debit, this $1.40 that I'm spending, is making a potentially $500 larger trade. So if you look at what this looks like graphically, and this is why I chart this in this way, my profit hump just kept getting bigger and bigger and bigger. Even though I was paying money, I was able to see where this was. The stock was trading up here at 197. So what I was doing was I was continuing to move this over, and it was all about this break even. Move this break even over as far as possible, because this is how I would defend the trade. At this point in time, if the stock went down, it would actually benefit me because these positions would be moving up into the maximum profit range. And as the stock eventually came back down, we can see what happened. So from August to September 12th, this is almost a month, the stock dropped $9. Well, all of a sudden, I was able to roll this up. I was still thinking there was upward pressure, but I've got 2 calls working in my favor. And I actually spent a small debit again, just to raise this upper level a little bit. I wanted to have as much upside protection as possible because I was worried about the stock rallying overall and I wanted to make some money. I didn't mind paying these debits. And again, I'm paying these debits as small amounts out of the initial credit collected. When the market started to come back down, it's coming down into my profit range. I was able to roll out and up one of these strikes because the stock was still trading at 179. I even rolled it up while collecting a credit, further reducing my downside risk. And then I paid a small debit to close the 190 after we had a substantial drop on September 26th. So yesterday I closed. The reason that I did that yesterday was because I wasn't sure what was going to happen today. If we had seen a substantial rally today, I would have wanted to get back into that second call. And that second call only cost me 2 cents to dump out. So I did. You know, you never know what's going to happen in the market. And what has happened overall over the course of the last 97 days is, in reality, this stock has barely moved. It went from 168 to 164. So a $100 position has lost $400, and I've collected $500 in credit. So when these expire worthless tomorrow, and in all likelihood they will, if the stock is trading at 164.84, I will have lost $400 in my account due to decay of the value of the long stock position, but I would have made $500, which means that this is overall a profitable trade. Now, it's not a massively profitable trade, but it is a profitable trade overall. And on a very, very extreme situation where a stock rallied extremely high from 168 all the way up to 197 and then back down to 164 where it trades today. So I hope that that kind of insight allows you to understand how a call like this can be managed. Now, if I had tried to do that just with the covered call, I would never have been able to do it. The fact that I have two calls, both gaining extrinsic value, is the key to that trade. So that second call gives me the flexibility because I have two options decaying at theoretically twice the rate against my long stock position. And it's why in my portfolio I have so many positions right now that have multiple call contracts on them, because I'm worried about downside and I need to be able to adjust these trades over time. Libastrani saying nice analysis for Zim, thank you. And I don't like the Tommy Options says I don't like the spreads on Zim. You know, for the spreads on Zim are not great. I agree with you, Tommy. The Zim is like a very much a covered call position. It's just like just in and out over the month. It's hard to day trade that. Not a day trade. I don't really day trade that kind of stuff anyways, but it's hard to weekly trade Zim. I have done it a few times, but you're looking for a strong move in one direction. A few words about Adobe. Well, Adobe, Adobe's a great little company. Let me just zip over here. No, that's not the one I want. Let me look at Adobe. Adobe's is just an expensive product. So I've held stock before. I've sold covered calls against Adobe, but at 276 is high valuation. I mean, I was actually doing it when it was in the, God, I feel like it wasn't even that high. I feel like I did it last year. It must have been earlier this year, because I don't think I was trading at 56. I was trading it at in the 400 range. I was holding some shares for a brief time. Overall, I was able to make a profit on this, but we have seen quite a substantial drop. Now, one of the things about Adobe is they are, again, profitable company. So overall, I like them. The problem is their growth is starting to stagnate. I mean, for people like myself, I mean, I've been an Adobe user since like 96. So I'm almost 30 years. I'm a small business. My Adobe cost actually is extremely high. It costs me about $900 a year to use the Adobe suite. And that's a substantial amount of money for a small business owner like myself, but it is a product that I use. So when I look at that kind of thing and I look at the value that it provides as a longtime customer, I think that there's many people like myself out there that are willing to spend the money because the product is so premium and it works so well. the fact that they're profitable now, and the fact that I believe in my heart that there's people that are going to continue to use them because they just have a massive hold on the industry of the graphics industry. And the way that their pricing structure works, so that we can't just buy the software anymore. Used to just be able to buy it for $1,500. Now we pay this annualized fee to be part of a Creative Cloud. I don't believe that they're going to be unprofitable. The businesses use them and individuals use them. So pretty industry standard stuff. So that's my, analysis from a personal level. Now, where is it going price wise? Again, why I'm not holding the stock right now. It's a little bit hard to say because this is like investor sentiment, right? How many new users are coming out and using the software? What is their potential growth going to be in the future? And I actually agree with Seeking Alpha in this, in that there's a likely negative momentum in Adobe from an investment standpoint, only because the interest rates. I mean, this is going to, when the economy is slow, people don't have extra money. When they're taking a look at their expenses, they're going to be cutting any superfluous items. So I think the core business is going to be okay, but does investor sentiment work? Not that it may not have a great outlook. Obviously, their earnings was adjusted. They adjusted their forecast year over year, and we saw this quite large drop on earnings, which is not very typical. Normally, there's not a lot of movement on earnings announcement, and then since earnings, we've seen a down move. My personal opinion is that Adobe will continue to drift down for at least the rest of at least this month, continuing on. When is it going to find its bottom? It's going to find its bottom when the valuations are extremely, extremely lucrative. Right now, the valuation is still a D+. So this is when we're looking at shares outstanding divided by the price of the shares. So the valuations are not yet low enough. I'm not surprised that there's a hold rating on here. I would actually recommend, no, not that I recommend. I didn't say that. Recommend. I would assume that Adobe is going to drift lower, and I would not be taking a bullish stance on it at this point in time. When this valuation gets lower and when its growth reverses, then I will be taking a more bullish stance. For right now, I'm not actually trading Adobe. It's just not even on my radar. It's a little bit too hard for me to get a good handle, and it's not trading in a range. I like stocks that are range bound, not ones that are just moving in a single direction. Theory is asking, for 600 more, do you think a stock like SU is better than DBX for a covered call? Well, they're totally different. I mean, asking like better, I have both DBX and I have Suncor. They're totally different products. So when I am building a portfolio, I am looking for diversity. Obviously DBX, which is Dropbox, is a technology company. Suncor is an oil company. So they're totally different. I hold both. I can't, there's no decision there. It's just I have to diversify. Armen says hi from Germany. Hello. Guten Tag or Guten Abend. I'm not sure, but it's like 8 o'clock at night over in Germany. So Guten Abend it is. How do you best choose your underlying? Well, I have a watch list. Let's look at this. So here's a watch list that I have in IBKR. This is not all the stocks that I watch, but this is a good number of stocks that are kind of on my watch list. When I'm choosing, it depends on the type of position that I want. Obviously on a position like Rocket, like I'm actually quite bearish on Rocket right now with the interest rates going the way they are. I just feel like the stock is going to continue to drift lower. So if I have a strong assumption, then it's pretty easy. What I'm looking for is high IV, and right now everything's high IV. So I make a list, I look at the stocks, I follow the stocks. The stocks that I'm buying are ones that I've done my research on, that I like the position, whether or not they're profitable. That is a massive thing for me right now, looking for profitable companies, and then just trading that range. So I personally have developed researched and developed option strategies that work for any environment, any stock, which is awesome, because when I started trading, all I could do was sell puts. I learned to sell puts, and then I eventually learned to sell covered calls, which I know is kind of a reverse order for a lot of people, but that's just how I was. My margin account was where I started trading options. I never even did it in my TFSA for many, many years. So covered calls were not a thing. And I learned to sell puts. That's kind of the bread and butter. Almost all of my strategies are based off of that. In high IV environment, obviously, put selling works extremely well. It's the simplest type of trade. Trading underlyings that I don't mind owning. That's the key. So research the stock, have a overall bullish assumption, trade short puts. When I'm shorting stock, it's a bit of a different strategy. Obviously I'm looking for companies that I think are going to fail or that investor sentiment is going to go down. But having a good list of stocks is important, and that stock list just builds over time. I mean, I've been trading stocks now for 25 years, so that list just keeps growing, and I have pretty intimate knowledge with a lot of the stocks because I look at it every day and I talk to people every day about it. It's not my job, but it's my job. I'm in a chat room talking about positions. So that's how I do it. I just do it off a watch list, and I don't typically trade outside of this list. I have about 200 stocks, which is more than enough for me to track. And even some of these got thrown on here from us doing live streams, and I don't even know what that position is. Can I just delete this? There we go. So I should clean this up because there's some stocks in here that I just don't even know what they are or that I wouldn't trade. Not that I just, you look at them like IMAX, there's just not enough liquidity on it. So you can kind of go through. And again, I know what positions I like and which positions I don't like based on previous experience. Voice space at 489. Yeah, so, you kind of occasionally... always adding positions, but occasionally going through and cleaning up as well. So that's kind of the long and short of that. Time is at 12:18. Bruce's music journey, excellent explanation. Thank you. You're welcome, Bruce. Thank you. Tommy options. You don't want to get too aggressive. Allow time for reversion. Tommy, I'm assuming you're talking about the strangles. I agree completely. Don't want to get too aggressive on choking down strangles. Armin's asking, do you also sell options on European stocks? I do not. Tommy options, that was a proper adjustment. Thank you. Appreciate that feedback. Foyad Graya, hi. Thoughts on IVR, mortgage REIT? Weird options, but high yield. What are your best stocks, ETFs you trade regularly? Then I've got somebody looking at Bank Nifty. Let me look at IVR. I know IVR. Oh, yeah. But I don't know it. Weird options, but high yield. Okay. I'm looking right now. I'm looking at, there's not a lot of volume. High yield 11. How much room does this have? That is high yield. Wow. I'm assuming it's mortgage, so it has tons of downside risk right now. Stocks falling off. I would be looking to play like put ratio spreads on this if I was doing anything. $10 stock drop to $9.60. If I was going to play not directional, if I was going to trade this neutral, then I would be looking for a position. I don't know what to say here. I mean, there's tons of risk here because there's so much risk. I would want to do something that was like a put ratio spread to give myself a really low break even. If I could get some money to open this, which doesn't look like I could, but that would be the thing that I would do. Maybe to juice it up just a little bit, you do like a little butterfly with one naked put. I mean, it's showing that you can't make profit. This is like a lose-lose-lose situation. Probability of profit 0%. But reality is it's all about the credit you collect, because obviously if you get 10 cents, then everything above the 10.50 mark would be a 10 cent credit, which would be a winning trade. And then anything from $10.50 to $10 could make up to an additional $10. So the max profit on the trade would be $60, which is extremely high. But that's only if you can get filled for at least 10 cents. And if the 10 cents doesn't eat up all of your commissions. And in my case, this is like $5 or 5 contracts. So it's like almost $5 worth of commissions. Makes it pretty tough. I mean, maybe the simplest thing is just to play a short put on it, collecting 20 cents. If you can get filled for 20 cents, 2% return in 24 days with the break even around 880, which is, that's likely where we're going to be anyways. The stock's going to continue to drop, right? So it's very hard with the high IV, because if you trade this just strictly as a put, if you just buy a put, then you have downside. But if you're wrong, if it rallies anything at all, then you're just out the money, whatever you spent. So you could spend the $20 or $100. I mean, it has to move quite a bit to make buying a put worthwhile. I think that in this case, I would be looking at the, that 880 is way down here. So as long as the stock stayed above this level, be okay getting 2% return. That's probably the simplest strategy that I would consider on IVR. This is IVR. Yeah, you can see the beginning of this. We can see the fear in the market. As interest rates are doing this, and right here in June, I mean, this keeps coming up. I keep talking about this kind of catalyst event when the fear hit the max, and or that low point, and the put ratio, or the put to call ratio spreads. The put to call ratio correlation was high. We saw the market rebound. I don't know if that's going to happen. It's very hard to say. We could easily go lower on any of these. So that's that's my thoughts on that. Please link. Armin says great explanation, and Armin says it's now 9:20 in Germany. So yeah, that's like beer drinking time. I love Germany, by the way. It's one of my favorite countries to visit. So hope you guys are enjoying it over there. Kind of nice to trade in the evening as well, which I kind of enjoy. What else do we have? Bank Nifty. I don't even know what Bank Nifty is. I feel like that is. I'm gonna look here at Bank Nifty. This is in India. I don't know. I'm sorry. I'm not familiar with this at all. So I'm going to pass on this just because I don't like to talk about things that I'm not familiar with. ARKK is great for strangles. Yes, it is. ARKK, if I didn't own some ARKK shares, has been like an extremely lucrative trade. Now, the ARKK works well in almost everything because it sticks in this range pretty well. So as long as you play anything that's range bound, iron condors, strangles, double diagonals work quite well. ARKK tends to whip around, and the option premiums are massively high. So if we wanted to look at a position in ARKK, even on the weeklies, it's pretty easy to make money. Stocks trading at $38. That's October 21st. Let's just look at the weeklies. I actually like to trade ARKK on the weeklies. And it's a little bit late in the week. It's only Tuesday. 36. Let me just look here. Where I didn't put a trade on. Normally I trade ARKK as part of my 100K challenge, and I didn't trade it this week. I just wasn't sure what was going on in the market. 36 right there over the next 4 days, and then I would trade this like at the 44, because even if we get a rally, it would be not that strong. So can we get enough money from doing that 40? No, nothing on the call side. I would probably just play this as a diagonal, and then just go out any amount of time here. Just go to January and just buy a little diagonal, $300. Yeah, that's not a very good setup, is it? All right, I usually play these as double diagonals. Typically, if I'm playing ARKK, I'm entering it like as soon as I can on Monday morning, and I'm playing some sort of range. So I would, be buying some positions knowing that, let me just go back to list view here so it's a little bit easier to see. September 30th, I would trade like the 44, but that's not making a huge amount of sense because there's no extrinsic value. You'd have to play so tight. And I didn't even look at RK this week, but now that I'm looking at it, I would not be taking this trade. This is a little bit too tight for me, from the 35.73 to the 41.26. But this is the type of trade that I typically am looking for in RK. And again, same with, you can do a little spread, like there's a bull put spread. And on the weekly, the 44 is only one delta, so it's just too low. But I could go a little bit further out and it would probably be much easier to build out. So now I can do the 30. Boy, there's not a lot of upside premium in this at all. So there's a little strangle, pretty easy to do if the stock stays in range between 33 and 43. So almost a $10 range makes money, and pretty decent money. I mean, if this was open for $80, massive return on capital. And then depending what other positions you have, obviously the margin impact is negligible if you have long calls in play. And yeah, RK is a great little stock to play. All right. Aaron, are we going to go up unless we go down? Well, of course. Chanel says, first time here, are you trading stocks or options? I'm trading stocks and options, but typically I'm trading options. So looking at options strategies overall. And Aaron, in answer to your question, are we going up? I would hope so, but honestly, my assumption is pretty flat at this point. Goldman Sachs just said their year end for the S&P 500 is their year end expectation is going to be 3,600. So let me look at SPX here. If we take a look, 3,600 is their year-end expectation, which is like right here, 3,600. So pretty damn flat, if you ask me. That is their expectation. What is my expectation? I don't think we're going to be seeing over 4,000 again for the rest of the year. That is where my upper limit would be if I was putting on a trades. I kind of have that in my mind, that 4,000 level we will be at under this for the rest of the year. Are we going to be down under 35? Could possibly be, but my expectation is that if we do trade down, we'll probably see some bear rallies and we'll start to kind of peter out and do something kind of like this for the rest of the year. We might see some aggressive moves like we've seen recently, and then leading up to Christmas, we'll have some moves that just can't break up. That's my personal assumption, and this is just me 100% guessing. That's what it is. There's been lots of volatility this year, and nobody can ever say, "Oh, this is what we think the market's going to do." Even the Goldman Sachs analysts, like when they're running that, they're running it on math. They're trying to figure it out, but they're frequently wrong. I mean, they just made an adjustment from 4,300. So their year-end target was 4,300, and they've lowered that considerably. When they make an adjustment like that and they lower this, I think that starts to push the market in that direction. There's a ton of fear right now. People are not expecting a rally, so therefore there won't be a rally. As of late, the volume's been a little bit light. There just hasn't been buyers stepping in, which is why we've seen the stocks dropping, but we haven't seen a huge volume of selling either. So that has been good overall. I mean, we haven't seen a massive sell-off, and I'm quite hopeful that we don't. I don't really want to see a sell-off. I hold enough long positions. Right now I have enough long deltas that I don't want to have stock market dropping at any point in time. Foyad saying, love your videos, just waiting to increase my tiny account a bit, then join your Discord. That would be awesome. You can join the Discord anytime. It is month to month. So if you guys are interested in doing that, you come into the Discord chat. The access for the options chat is through Patreon. Once you're in the options tier member, it's $50 US a month to sign up. And then you get a free copy of my rolling options record keeper from my website, which is $50 anyway. So basically your first month is free just for getting that spreadsheet, which I show in all my videos. It's what I use. It's how I learn to roll options and how I learn to mitigate my risk, because visually, it makes so much sense when we're looking at these positions. And I know some people, there's quite a few people that are just joining the chat right now. So if we look at the way that my rolling options calculator works, I can adjust over time, and I can see graphically the adjustment before I make it to see where my profit and loss on a rolled position is going to be, because sometimes we have to roll positions. And up until recently, actually today I entered one. Today I entered a unicorn, but because I haven't played them in a while. But unicorn strategies are diagonal, so normally I put them in a low IV environment. And right now, most of the positions that I have on are either put ratio spreads, strangles, iron condors, types of trades like that are high IV strategies because they're the simplest ones to enter. When we're in low IV, when we're playing diagonals, it's very important to be able to track those rolled positions over time, because we need to know if we're making money over the course of the position. So we need some ability to track it. And diagonals can get split up in our brokerage, so they can get a little bit messy. Iron condors, strangles are much easier stocks to track in general. So it's a much easier type of thing to manage, but the software allows me to basically track these positions over time. So it's pretty amazing. And that's one of the things that people get when they join Patreon, because if you do that, you get to see my live trades, every position that I have on. You get to see the Discord chat, obviously, and I'm on during market hours, and then my live trade alerts when I make a trade, when I make an adjustment. And there's quite a few. I make about anywhere between 10 and 20 adjustments per day, and I'm putting on about 10 to 20 new positions a week. So Tommy's asking, how's my luck with weeklies? This week has been, or this year has been extremely brutal for weeklies. You know, I've been recently doing some zero DTE trading, which I'm actually prepping a video on, and that has been a little bit more lucrative than the weeklies. But with these swings, what we've been experiencing is just strong directional moves, and the weekly strategies have been extremely difficult to make money on. But you know, you have times where we don't make money, and then there's years where we make tons of money. So it just varies, and I'm hoping that the rest of the year is going to be a little bit calmer, but who knows? It could be just as volatile as the rest of the year. So, and Bruce's music journey said just joined. Thanks. Well, thank you. That's awesome, Bruce. Appreciate it. And appreciate all you guys joining me today. It is 12:30. We've been here for an hour and a half. I am going to call it quits, and we are going to see you next week on Tuesday. For my patrons, you get to see me on Thursday, same time, 11 o'clock Pacific Standard Time. Bring your questions, and we will talk options. Thanks so much. Have a great day. Let's get rich together. Take care. Bye.